Good morning, everyone.
I know, right? It's bright.
If you can just come, there's some seats in the front. Is everyone here for the state of the tax credit market and update? I'll say that one more time, an update on latest developments.
As of today.
As of today, what's the time? It is 5 after 11
Right?
on the 11th of May.
News story at the Wikipedia one, right?
Before we get started, I'd like to just give a little bit about the logistics about the room. As Brian mentioned earlier this morning, this session is being webcasted, something new to us and actually new to me. So there's a few instructions for the room and for the group, and so I'd like just to share those with you. So first of all, I don't know who's out there. I'd like to say hello to our viewers on the web. Thanks for joining us today. And thanks to KML Law Group for making the webcast possible. They are our forum webcast sponsor. And this is the first of 3 sessions that's going to be webcasted today, all in this room. So when you come into this room today, you know it will be a live webcast. We knew the session would be popular. I believe it was sold out, so to speak. So to reach the most people, we decided to webcast this session. So for those who couldn't make it into the sessions today. We hope that you enjoy the webcast. During our session today, if folks viewing the webcast have questions, just please post them as a Facebook comment. Hopefully you know how to do that. I'm not sure I do still. Might need my kids. And we'll monitor the comments and we'll do our best to provide the answers to your questions as they come up. Let me add that everybody wins with this webcast today because we are also recording the session. So after the forum, we'll archive this session online for everyone to view at their convenience. Watch for an email about this, or simply visit PHFA's YouTube channel a few weeks after the forum. The web address is youtube.com/watch PHFA. So with that, I'd like to start our session. Again, really pleased to be here today and have this current conversation about where things are with the tax credit market with 3 individuals who will hopefully give us guidance on where the market is today, where it might be going in the future, and what might or might not happen with tax reform. During the session, we are also happy to take any of your questions. There's a mic in the middle of the room, and again, as we're webcasting it, I think it's easier if you do and are able to get to the middle of the room to get to the microphone. That way everybody can hear the question. So before I start, I'd like to introduce our illustrious panel. To my far left is Tom Houlihan with Capital One Financial Corp. To his right is Chris Paul, who's with Diamond and Associates. And to her right, to my left, is Tony Lyons with the National Equity Fund. So thank you very much for being on the hot seat today and answering the questions that we have. So with that, I'm going to start right into the program, and obviously this is a hot topic, and hence why we're webcasting today, about the state of the tax credit market. With the advent of the new administration, I think after that day in November, things seem to have been changing in the low-income housing tax credit market. And so just a little bit of, I think, where I'd like to start the conversation. I should introduce myself. I'm Holly Glauser, Director of Development at PHFA. We saw a number of projects that we allocated 2016 tax credits, unable to meet their tax credit pay-in or some of the deal terms that were before them when the applications came in, and we awarded them in July of 2016. To that end, we provided a tax credit award to 39 developments. To the end of the year, we maybe had 3 or 4 of them that were able to execute and close on their tax credit investment. So there were about 35 developments that were basically sitting and waiting and seeing if they could come to fruition. So I'd like to start with you, Tom, on the end. With some uncertainty and really just talking about pipeline, where did you see things at Capital One? How did things play out? Any conversations about where pricing is, holding pricing, and whatnot. So what did you see?
Yeah, absolutely. First, as the president tweeted, I just want to make sure whatever I'm saying now makes sense in like 2 seconds later. Thank you for this smattering of applause. Yeah, right? Yeah, there we go. Trying to loosen everybody up. So for us, post-election, what we looked at were deals that we had awarded credits and were signed up. And so for our case, that was 3 deals in Pennsylvania, of which we've closed 2, and the other one we're in a process of closing. And our kind of message to those folks were, we're going to stand behind our letter. We just need to get the closing as soon as possible. And for the other folks that maybe we were looking at who hadn't RFP'd yet, we just simply passed on the deal. But for the folks that we had signed letters of intent with awarded credits, we're standing behind them.
Okay, great. Tony, we'll go to you next. I think just beyond that conversation a little bit is, what are you seeing with the projects? Were they holding? And did it make a difference of where the investment was being ultimately placed? So if you could talk about that a little bit. Sure.
So yeah, it was kind of all over the map. I think Capital One is a good example of one investor that was willing to stand behind their commitments. What we found at NEF was that most of the proprietary investors that are in the market, we work with most of them, virtually all of them were willing to stand behind their commitments. So if they wrote a commitment letter pre-election, and as long as that project had a closing date that was, relatively reasonably into the new year, in the first quarter or second quarter of the new year, that most of those proprietary investors were willing to stand behind their commitment and close. Where it got a little hairy was on projects that were targeted to a multi-investor fund or projects that were targeted to a multi-investor fund that wasn't yet closed. And there were a number of syndicators, NEF included, that had kind of a fund on the street. The fund offering was out. There were some deals that were targeted to that fund, but the fund had not yet closed. And then all bets were off. Most of the investors that were looking at those funds kind of took a pause and said, "We got to see how things play out. So we're gonna take a break and see, and then come back to it in a couple of months when things settle down with the talk of tax reform." So projects that were kind of in that category. Some of them found themselves in situations where they were being renegotiated. Pricing had to drop. And that was a situation, many of the projects that Holly was referring to here in Pennsylvania were probably in that category and felt a need to go out and then renegotiate or issue a new RFP, select a new investor, a number of different approaches that they had to take. But if there was a proprietary investor involved, by and large, those deals are continuing to close and move ahead.
So with that, so Chris, you're on the other side, and Chris is here representing the developer. What happens? What do you do when, you're sitting here and the price went repricing or pre-changing was $1 or $2, and now these gentlemen are saying, we're at maybe 95 cents, 92 cents. What do you do to try to make the deal work?
Well, you cry, first of all, and then, I think FAIR was a godsend to the state. So the FAIR RTT funds were available, and many clients went for those. I mean, we had a deal that actually went out in a procurement before the election, and we only got one bid on the rather large, pretty amazing deal that would have typically attracted so much interest. And that was, really evidence. I mean, I was basically begging, one bidder to stay and calling people instead of them calling me. It's been a huge struggle. And we had 2 deals in the same city, both with proprietary, one, both with signed LOIs, one held, the other didn't. And so trying to figure out how do you, why is one developer able to keep this, their price, others not, and folks really just trying to talk to everybody to get anybody interested. I think the worst part was the November to December. I mean, I felt like in January, at least, there was a bit, people would call you back. Sometimes people didn't call me back.
Sure, but I'd echo that. I think the month or 2 right after election, at least from the bank's perspective, it was crazy for us too. I mean, the phone is ringing, folks looking for certainty on the deals that you're already looking at. Hey, I have something else coming down the pike. How should I be pricing it? We're in the same boat as everybody else. We don't know. But I will say January, February, once we started kind of catching up on this panel, I felt a little more calmness in the market and maybe a little more certainty. But that happens, and then you see the president says something or something else comes out, and immediately it's kind of makes everybody a little uneasy. But I think what we can hope for, and maybe what comes out of this, is maybe a little more transparency than you were used to with your lender, investor, and all the other parties involved. Because I think going into a November application season, I think everybody's going to be eyes wide open. They're going to know who their parties are, and they're going to feel confident that when they go in and they get awarded credits, they're going to feel pretty good about being able to close.
I think for the group, and just to talk a little bit about what we saw in the pipeline, and I think it's great. Congratulations on closing the couple of deals. I know that you're working, and everybody's really working to clear out the 2016 pipeline. Just for the group, and I just thought it would be of interest, maybe or maybe not. We had 35 deals that were in our pipeline. Of the 35, about 18 actually either we think and we hope are closing on price, and actually one or two went up a penny or two. The other ones, as Chris mentioned, we had the fair RTT funds that we were able to assist those that have been repriced. And yet, unfortunately, we still have a couple that are still looking for a home. So please use this time wisely to talk to many of the folks, the two of you, and I see a few others in the room, to try to get them done. I think there is some stabilization. I think, again, maybe just talking a little bit about deal terms or other things that you're seeing right now of how to just get some folks over the hurdle. Any words of wisdom or other things that you can say if there's those couple deals out there right now that are still shopping?
Sure. I mean, I can say since election, our kind of pricing guidance has moved multiple times as we've kind of tried to figure out the marketplace. Right now, for new business, we're pricing a 25% tax rate, no adjusters. We looked at the adjuster concept. Capital One we work with just syndicators. We don't do direct. So if you work with somebody direct, maybe it's a little different. But we couldn't get comfortable with how the adjusters truly would work. So for us, the simplest solution was a 25% tax rate, no adjusters. And I think we feel very confident pricing that on both active as well as application deals will put us in a good spot coming out.
Yeah, I can talk about that a little bit. So how different investors are approaching the adjuster question is kind of all over the map. And again, it's going to come down to whether you are talking to a proprietary investor or a direct investor or a syndicator who's going to put a deal in a fund. And, I'd say that the adjuster question, as Tom was saying, gets really complicated. There's all kinds of implications that come up around things like what's the timing of when that adjuster would happen? How long would the investor be willing to wait before they are willing to pay the adjuster? There's a question of whether if you're willing to take an upward adjuster, are you also willing to take a downward adjuster? Many developers don't like the idea of a downward adjuster for obvious reasons. So there's all kinds of questions that come up, and there's also the question of, well, where does the money go? If you get paid an upward adjuster, will Holly come and try and take it from you?
Or Linda.
So those are it just gets a little hairy, and so Capital One and I believe Bank of America has come to the conclusion that they just don't want to go down that road and deal with adjusters. So they're willing to give you maybe a little bit more aggressive pricing on their assumptions around corporate tax rate, but they're not willing to talk to you about adjusters. And if it's a multi-fund, adjuster conversations are non-starter. They're just not going to be able to. When you have 8 or 10 or 12 investors in one fund, you're not going to be able to get them all to agree on how an adjuster could be paid out. So it really depends on who you're working with and how hard you want to push, frankly, on that question.
And just to add to that, I mean, I'm talking more about 9% deals. Those are most prevalent, at least what we do in Pennsylvania. 4% are a little harder, so the guidance there may not be exactly the same because we're going to jump in and do a little more digging up front to see how the deal actually looks and how the financials work.
So I think we crossed a little bit into, I'm looking at my little questions here and where we are of deals that are in our pipeline, and I think those in the room who are still working through, we hope to get you all there, and we hope you all get there. But yesterday, many of you in the room were at our pre-application meeting, and we had over 300 people there. And Roy's shaking his head about that. I think, and it's interesting to me, and just really looking at the lists, that most of the lists were developers, consultants in that space, and not really as many ancillary other partners. And so, to the extent that there's lots of applications coming in the door, and also with the advent, and maybe we'll hold off on where we think tax reform is, but in this interim period, any guidance on conversations that you're currently having on that September 8th pipeline? Maybe Chris, we'll go with you first. What type of things, as you're starting to, and Chris calls me often, starting to noodle the numbers and saying, this is my total project cost and how am I going to get there? Thoughts, guidance, pearls of wisdom right now now it's 11/18.
11/18, yeah. I mean, it's a struggle. I think it's a huge struggle because I guess I'm also an optimist and hope that we're going to see, prices creep back a little. It's been, I think we have deals that we pro forma initially at the higher pricing, and now there's this gap, and construction costs have not diminished. Though Roy believes they may go down, but not in time for the round. And so, trying to really figure out how much soft money, and I was quite disappointed that the fair pot is so small because it's going to be in high demand, I think, as deals try to make things work. And where we are is, do we need to rethink our unit count, which is really a depressing thought because, first of all, work has been done already, and second of all, it's so much work to build these units. I just hate to take a few more units out of the market, but so that's kind of the balancing act that I think we're going through with deals and really trying to figure out what's the best way and how much soft money can we squeeze in, what deadlines match, and it's a struggle.
Tom, do you want to go next?
Sure. So just kind of in general, I mean, I'd want, you have the two products, right? You have a construction product, which is pretty straightforward. I'd want to know how my lender is going to eventually underwrite the deal so that my budget that I'm putting together to submit makes sense. So that's contingencies, reserves, et cetera. And then on the investor side, I'd want to know who my investor was. So if you were doing direct, you're obviously going to know who that person is. But if you're like Capital One, we work with syndicators. So if you were talking to Tony, you'd probably want to talk to me and say, okay, are you confident in this pricing that you're giving me? What I've seen in a couple other markets that I work in terms of Delaware and New Jersey, they provided pricing guidance, which I thought was a smart idea. They'd reached out to the respective development community and said, what do you think is fair today? So if an application came in with an outlier, either really high or really low, folks would ask the question, is that letter legitimate? Because we know you're not issuing a commitment at application stage. It's simply a letter of support. So that's it.
Tony?
Yeah, so I think everyone's just going to have to be very practical and conservative, if you can, around what your assumptions are going to be around pricing. And, in Pennsylvania, everyone in the room here probably is aware, you have three markets. You have Philly, Pittsburgh, and then you have everywhere else. And, there's a strong CRA demand in Philly, to some extent also in Pittsburgh and some other pockets around the state. But those markets, Philly, Pittsburgh, and a few others, are going to be able to attract some proprietary and perhaps direct investor interest, and are going to get premium pricing, particularly if it's a developer that has a track record and strong relationships with their investor partners. Then there's the rest of the state, and in those places, you're probably looking at a multi-fund kind of execution, and the pricing on those kinds of deals are just going to be a lot less. So as PHFA is looking at how they're allocating their resources, they're going to have to take that into account, and hopefully be able to attract higher pricing in the larger markets, so they can use the resources that need it in the places where they're not going to have as high pricing. So I mean that's kind of the reality, and as you're putting your deals together and your numbers, trying to factor that into your assumptions and plan accordingly.
Sure. And I would also add, working with folks that if you've gone through a deal with somebody before, whether it's a syndicator, a lender, investor, I think that's helpful in this environment because you kind of know what their expectations are already. If it's a truly new relationship, then I would spend the extra time pre-application to fully understand what their expectations are going to be when they actually fully start underwriting the deal, because it may be different than what you think it is today.
Okay, so I'm going to ask the question because nobody's raised their hand yet or come up to the mic, and I'm not sure if we talked about this earlier, if I was going to put you on the spot and ask actually the
Thank you in
question.
advance.
You know, what do you think, where do you think pricing really is right now? If somebody is going, and Chris is working on her deal right now and trying to start to sharpen that pencil, and then we talked about the different markets and the different funds. Tom, can you give us just an indication of where you think Capital One it might be on pricing?
Yeah, so Capital One, we're really focused on Philadelphia. Every now and then we'll go to the adjacent counties, but it's really Philly County. I would say you're in mid-90s. That's kind of in line with a 9% deal with a 25% tax rate with kind of a standard equity distribution throughout the deal. So if you're there, I think you should feel pretty comfortable.
Tony?
This isn't being recorded, right?
Yeah.
Nobody's watching.
Right. So we get the question a lot. I'm sure Tom does too. Where's pricing going in the next year? A lot of it is going to depend, obviously, on what happens with tax reform, what happens in Congress, and none of us know the answers to those questions just yet. It's still really playing itself out. I do sense that there is a settling in the market that's happening. Where investors are realizing that, if tax reform happens, and by the way, tax reform, I think many agree, is eventually going to happen in some form, whether it happens under this administration or the next. It's just something that's been talked about for years in Washington. It's going to happen. So the question is, what's it going to look like, and how long is it going to take? And it's going to need bipartisan support. I think many people agree. So whether that can happen under this administration is a big question mark. So what's happening in the market, I think, is that investors, and here's the good news, investors still need tax credits. They still are under a CRA obligation to invest in these communities and buy tax credits, and that there's no talk that the program is going to go away or be eliminated. And so investors that have been kind of taking a pause or a timeout the last 6 months are eventually going to have to come back into the market. And so what that's going to mean is there's going to be more demand, and demand is generally what drives pricing. So doesn't mean you shouldn't try and be as conservative as possible in your applications in this upcoming round, but I think there's a strong likelihood that pricing is going to rebound, maybe not to the level it was pre-election, but it's probably going to continue to climb back up again, I think.
Did everybody write that down?
Yeah.
And I think that's something just from our perspective as the HFA, and I think I just wanted to talk a little bit about, you did talk about whether you have the tax credit adjuster language, whether you have difference with repricing. We haven't done yet or thought about yet doing a minimum underwriting or a number that you're going to underwrite to, like New Jersey or Delaware. I think one of the things in Pennsylvania is we've always, you have a question?
I did, sorry.
Okay. Here.
That was for Philly. What about non-CRA?
Okay, question on the floor is that there was pricing for Philadelphia, but the question is for non-CRA pricing, so if somebody can speak to that.
I'm hearing 87 cents and 86 cents on deals in the center of the state and lower, which is very painful. I'm very sad.
Is it cocktail time yet? Okay. But one of the things that I think that, and just sitting here today, and obviously with the uncertainty is, and with the, next applications, and it's been interesting as we've had these conversations, what is it going to look like on the day we're having this meeting here today? I think the agency is still going to be in a position to be flexible. I think we do look at, and we always have looked at, what market looks like, and, rewinding back to 2008, 2000, when the fall off happened before stimulus. I remember the days that we were in the high 90s, and then I wrote a letter and said, I think we're going to do everything at 87 cents. Does it work? And I remember developers saying it's not going to drop to 87 cents, and that doesn't work. I think the agency is going to be in a position to be flexible, figure out, and when applications come in, take a look at what the market is at that point in time, and maybe go back out and say, this is where we need to be. And I think all of us in the room understand understand uncertainty, and really are going to try to work, because, where we are is as Brian talked about earlier this morning, there's 120 applications that come in the door. 60 to 70% need to be done, should be done for those communities. And once we want to work with somebody or want the development, we're going to try to do that. So again, I think it's just an unknown on that. Chris, you looks like you have something to say.
Yeah, no, I'm just the same thing, that it's this struggle of really balancing and really looking at how competitive the project's going to be and what can you strip off in order to make the budget work better without making it less competitive. And that's,
And Roy, before I call on you, one of the other things I do want to talk about, and Tony, you did mention the question about what to do with a few deals right now that might have tax credit adjusters in them, and what does that look like? We haven't seen any yet that upward adjusters I'm talking about. So I don't think we've had any yet that have formally closed that have had them. I think the question on our side is if there is additional dollars, if tax reform doesn't happen and now you're 4 years out, which is something that we're seeing, what is the agency going to do? In the cases that we have loan funds, so for example, we've given additional FAIR dollars or National Housing Trust dollars or additional Penn Homes, I think we're going to be looking at that a little differently than if it's a credit deal because we actually are a lender. It's a little bit more complicated on how to work through that when we're not a lender. And so I think from deal to deal, we're going to look and see that language and see what space we want to be as far as, a recapture, specifically if we've gone out and given additional dollars that are really obviously just vital to keep our mission going. And so Roy, you had a question.
I know.
Can you stand up? Can you go to the microphone in the middle of the room?
Holly? I know that the leadership of PHFA has a strong parallel relationship with the leadership of the Pittsburgh Federal Home Loan Bank. And it occurs to me that the one source of funds that's actually robust in our market is the affordable housing program because member banks are making more money today than they used to. And I wonder if a little better coordination so that commitments out of the affordable housing program could arrive prior to the application on the tax credit, then those sources of funds could have a bigger impact than simply monetizing deferred developers fee. And I don't know whether that's something that you and they have talked about. It could ameliorate a little bit this situation.
Yeah, I think it's still worth continuing the conversation. It's all about timing and where they are in their timeline. I know that is anyone here from the FHLB Pittsburgh? There we go. So
Timing is same as last year, June, early June for application open, August 10th deadline.
right, so the application deadline is still August. I think it's been one of those things that everybody's always looking that they're the last money in the development, and I think that's one of the challenges we all have with our resources. And so to the extent that we do talk to each other, we do talk during the process, so when their applications come in, there is some kind of joint conversations. But it's still a challenge on who comes in first, the chicken and the egg, and making deals feasible with the number of applications that we get. So Roy, I don't have it. I wish I had a better answer for you on that one, quite honestly. Any other questions before we?
there's one in the back.
In the back, George, come on up to the microphone.
Holly, good morning. Has anybody in the room seen an actual tax rate adjuster? Because we're working on 4 different deals, and I've not seen anybody even put out anything near a draft of what this thing could look like, upward, downward. Do you guys see it? You guys seen a document?
Yeah, I'm not aware of any, there's no deals that we've closed yet that have upward, downward adjuster provisions in them, but there's definitely investors that we're working with that are entertaining them and trying to figure out what they're going to look like. So I know of one investor that's willing to say they'll agree to an adjuster for up to 5 years, and it would be upward only. They would start at a relatively low tax rate, 20-25%, and then agree to an upward. There's another investor that's talking about a 2-year time frame that we're talking to right now. So they're definitely being negotiated, and developers are asking for them, but I'm not aware of any deals that have closed yet that have them.
I think we have a few investor syndicators in the room, and while we have 2 up here, any other that are willing to share or raise their hands that are wrestling with this issue?
Yeah, I will.
Okay, can you please stand and actually go to the microphone or come up here? You can.
Here, you want to talk right here?
Come on, Steve. Let's hear.
I'm with Boston Financial. Steve Napolitano. We've got one investor who, in principle, the adjuster sounds conceptually like a good idea. In practice, it's a mess. It's a mess. We've got one investor who has tried to put pen to paper on it, and when you try to think about all of the things to include, it's really hard to capture them all. And so, at the end of the day, you end up like Tom. 25%, no upward, no downward. 5 years, 2 years. Do you take into account depreciation changes, acceleration? Excuse me. Acceleration. How far up do you go? How do you handle the downward? Somewhat downward, taken out of cash flow. Somewhat the developer to guarantee it. And that doesn't go over well at all. So really, I think people are gravitating toward 25, no upward, no downward, and leaving it at that, just because it's simple. And you're each leaving something on the table, potentially. The developer's leaving the upward, but you're also not getting hit with the downward. And people think that's not likely to go below 25, but it could happen. Who knows where it's going to land? Yeah. I think it's unlikely myself, but do you want to really be on the hook for that? Probably not. So that's kind of what we're seeing.
Okay, thanks, Steve. Appreciate that. And it is an interesting thing. I'm actually on a panel in a couple of weeks at the Bar Association, ABA, and there might be some pen to paper. We're seeing if actually the investor's willing to actually share. So if we do have it, I might be the first to see. So we'll see. So moving on to another topic. Any other questions on this? Okay, Ray.
Just to put you on the spot, Holly, what did you mean exactly by the PHFA would be flexible? Does that include more loan funds or more tax credits allocated to the deal? And how much of the thinking in this room is, and from the investor's point of view, is are you thinking about the possibility that if tax rates come down, there'll also be an increase by Congress of the allocation of tax credits to each state, which I keep hearing has pretty wide support, but what do I know?
Okay, I'll take the first one, and then I'll ask the other two to talk a little bit about the availability of credits. One of the things, and I think many of you who do practice in Pennsylvania, is we do take the pulse of where the market is at the time that the issues arise, and I use the term audible. So we tend to call them from time to time. So to the extent that we see pricing go up, we might, even after the applications come in, say, hey, pricing's going up. You gave us something at 92. We think it should be now 94, 95. This is either where we're going to underwrite it or go back out and go get a letter. So we're willing to do that. In the converse, we might say, give us some more time to do something. So again, I think that, sitting here on May 11th, we are anticipating it's a normal round. September 8th applications come in. You give us the deal, but if life changes, and maybe these two gentlemen and everybody else can talk about what life might look like, we're going to be in a position to do something like that, whether it's additional resources or allocate other set-asides. So now you can talk about that.
Yeah, I don't really have a whole lot more to say about that. I think that in general we're going to try and work with our developers to if we need to modify terms. If the market does change, there is talk of some legislation that could enhance the tax credit program. The Cantwell-Hatch bill is still kind of out there and percolating around Congress. And there's also a chance that if tax reform happens and they lower the corporate tax rate, they could do other things that will enhance the value of the tax credit, or they could allocate additional tax credits. They could tinker with the formula. There's any number of scenarios that could possibly happen, which is another argument for not getting into adjuster provisions and partnership agreements, because you just can't possibly address every possible scenario that might happen out there. But I think most syndicators, most investors will work with their developers if things change down the road after the LOI is issued, but before you close. There's some circumstances that change that affect the yield, affect the price, affect the credit amount, that we'll try and accommodate as best we can.
Yeah, I would echo that. I mean, it's impossible to work through all the hypotheticals at this point, which is why I think the simplicity of pricing today makes sense. The loaded question of you signed an LOI and then tax reform happens and they change the way the credit works, you know, like we do with all of our clients, and I think across industry, folks will work with you if they can, right? There's some guidelines that every lender investor has, but for the most part, we always try to work with the folks to come out with a reasonable solution.
So I'm looking at you, Chris, and thinking, what can I ask you next about this issue? I think as you're putting deals together, anything specifically either in this space as you're negotiating partnership agreements that you have words of wisdom to talk about maybe some of this uncertainty that or issues that come up that you might think, hey, I see, how do you play that off with others?
I guess I'm definitely trying to, and I haven't seen it presented yet, but adjuster language, definitely counseling clients not to, agree to that, because I think that is a dangerous and I mean, and I guess I don't know what it ends up looking like, but the idea that at any point you could have the rug pulled out is very scary. So, I mean, I think, we went from sort of being a developer's market to to now there's less leverage for the developers and trying to figure out, well, how much do you fight over any given provision? Do you have any leverage to sort of fight that battle? And it's a struggle with clients who sign an LOI and then maybe see a creep up. They wonder, well, could I do better? And and it's like, you have a letter. Let's just try to go forward, because really, do you want you don't want the flip side where somebody doesn't honor the letter and reduces pricing. So it's a real it's just a real challenge, and we need another TCAP program to save us as it did in 2009 or so. Because I think that's really, we're just opening up these massive gaps in many, many deals, and the federal home loan banks aren't timed this year to make awards in time for the PHFA application sufficiently. So it's just how do we make it work, and then to have the realty transfer tax revenues down and the National Housing Trust Fund down, like something's got to give, right? When will the costs go down? If all the money's going down, the costs should be coming down. So.
Yeah, I was just going to add that, transparency is real important too. If you're working with a proprietary, you know who that is. If you're working with a direct, you know who they are. You're talking directly with the investor. But if you're working with a syndicator and they're talking to you about a multi-investor fund, definitely ask the question, who's in that fund? Is the fund fully subscribed? When will the fund close? Will you have to warehouse the deal until the fund closes? Those kinds of questions as a developer is important for you to know, so that you can expect, how that will play out with them. And those are the deals that got into trouble after the election, where the fund hadn't closed yet, and those deals had to be renegotiated. So definitely ask those questions.
And I think those weren't questions we were asking previously. And I think, we definitely saw now you really need to know. And it does remind me of, again, 2008, 2009, when, we were basically going, seeming to go around the syndicators to talk directly to the investors, because we just didn't know how to make deals work then either.
Sure, and I would say the same should go for if you have soft monies in the deal, or if you're getting like project vouchers, to reach out to those parties and make sure they can provide you a realistic closing date. I think everybody thinks they can always close in a couple months, but sometimes things take much longer. And if you involve HUD or anybody else, they have their own process. So for them to provide guidance on when they're ready to close, then you can push that back to your lender investor and say, this is what I'm hearing. Does this work for you? And I think collectively everybody can then work it out.
Great, thank you. I'm going to change the topic a little bit, and I know, Tom, you brought up a little bit between being a 9% or a 4% tax-exempt transaction. The agency's seen a significant uptick in the number of 4% transactions that are coming to our doors. Does your investors or do your group make a distinction? Are they, what other considerations are folks looking at in the tax-exempt space? If all of you can talk a little bit about that, that would be great.
Sure, so we do both. As you said, I don't typically do a lot in Pennsylvania. I think we did one deal with Mission First years ago, where we just did the construction loan. But in New Jersey, we've done like a TEL. We do a lot of bond deals there. What I would say is, going forward, the scrutiny before we actually put out an LOI is probably a little higher, just to fully understand all the metrics of the deal. We'll highly leverage Tony and the syndicators community expertise on what if happens, if pricing changes. But once again, the pricing guidance of no adjusters will still hold, and I think in general, we'll still price at a 25% tax rate. I don't think they're more complex deals for sure, but that extra work done up front, I don't think it makes it harder for it to close.
Yeah, I would agree. Yeah, I think it's a real positive trend in Pennsylvania that this is happening more and more. And the challenge with bond deals is how do you fill the gap, and how do you do it in a way that doesn't necessarily maximize the leverage on the deal. Most investors don't like to see a lot of leverage or overly leveraged deals. So if there's other money that can be brought to bear, like AHP or fair money or things like that, that can fill that gap. But I know there's definitely a push in Philly and also in Pittsburgh around finding more ways to use 4% credits and bonds. And they are a little more complicated deals, and there's issues around level of rehab. There's issues, tax issues that come up, around capital count, and not having too much debt that's accruing on the deals. And there's also, around substantial user issues that sometimes it works better with a syndicator as opposed to a direct investor or a proprietary, because the syndicator can sometimes have more tools at their disposal to be able to work around substantial user issues and warehouse the deal and bring in a way to bring the bond buyer in at the same time as the deal is closing with the equity. So it's just a little harder. I think the time frame to get the deal closed is going to be longer. So you just have to build that into your timetable and work through all of those issues.
Yeah, and I would say as before, maybe you would have said, I'll have this person be my lender, this will be the investor, I'll do my perm with somebody else, because you could leverage everybody against themselves and get the best deal possible. Right now, I think doing it all in one shop makes a lot of sense. So you're only just dealing with one party. Maybe they have an agency lender in-house that can do the perm. Tony talked about warehousing. We do that with just about all of our syndicator partners. They have the programs and the ability to do it, and I think it makes sense. Because once again, you want to be talking really to one person at the end of the day about the ability for your deal to close as, signed up. And I think if you have multiple parties, it makes it really tough. And, the agency, I'm sorry to keep going, we have an agency, Capital and Multifamily. They do Fannie, Freddie, just about everybody else. There's a lot of new products out there. The TEL is real popular now. We finally did one. I think that makes a lot of sense. So I'd encourage folks to do the research there and then to reach out to, the respective lending community about what makes sense for their project.
And I just wanted to say that I think on the 4% front, the attraction for developers is not having to compete for funding. So I think there's a natural urge not to go for the other sources like FAIR and AHP and really try to make the deal work just with the credits and the bonds. And I think my deal that was out was a bond deal where I only got one bid, and I still feel bad about it. So, I think particularly in the end of the year, there was even less interest in those deals. But I'm hopeful that, there still wasn't that much interest a few months later in the next bond deal. But I hope that it's going to come back. As I understand it, the losses, are so much greater, and so it's just harder to sort of underwrite it against the possibility of tax reform. But
And not specific to bond deals, sorry, Tony, but just HPs in general. If you're getting an award or you're applying, make sure you fully understand how the program and the scoring works. A lot of the HPs will require, the supporting bank or the member bank to be active in the deal. And usually that's either part of the equity or the perm debt if it's available. And if you're going down the path with somebody else and you ask another bank to support, you got to figure out how they're going to work together. It's certainly not impossible. Everybody can work together, but it may be another level of complexity that you didn't originally contemplate. So if you have Bank X, apply through their program. If you bring somebody else in, make sure they're aware of it.
Tony, did you have
Just to reiterate what Chris just said about the pricing on bond deals generally will be a little less these days because of the value of the losses. Bond deals generally generate more losses than 9% deals, and it's the losses side of the equation that is less valuable because of the lower corporate tax rate. So unless it's a very large bond deal where there's quick credit delivery, which you can sometimes do on a preservation deal, generally the pricing is going to be a little less.
I think over the years we've really changed as far as the state agency, what we're looking to investors and other folks to put together or assumptions before the applications come in the door. And I know following 2008, and not only Pennsylvania, other states are looking for harder investment letters. No, Chris is shaking no. And I think we know where that went as far as what's real and what's not real. I'm just curious. Is there any specific and this is, as Brian said, this is our 10th conference, and I think I probably sat at the table and moderated a panel like this probably every other year. One of the things that I remember in previous panels we asked is, is there still an appetite for specific types of deals? And I think we've talked generally about where pricing is, but is there issues or nuances with a preservation project or substantial rehab or anything you're particularly concerned, afraid of, cautious, or willing to entertain everything at this point in time? Because as folks are putting deals together, I think folks are generally curious about that question. So we'll just maybe go.
Sure.
Away.
On the rehab side, light rehabs are tough. They're tough for our folks internally to get on board with. If you're doing a gut rehab, I look at that almost just like new construction, but light rehab deals are tough.
But I think the difficulty is that often those are occupied rehabs, right? And so it's how gut do you go with
Sure.
folks in place? But I think the CRA areas, are the places where deals are easier, and even there they're hard. But so I think there's obviously a need in out in other parts of Pennsylvania, and those deals are just going to struggle more. I mean, the good news is that Penn Homes is available, and that gives some comfort to those deals. But that's not an unlimited pot either.
I think everybody always likes the shiny new 9% new construction deal, and in a high-end suburban community, but fact of the matter is those are not the deals that tend to get done in this industry, and I think we all acknowledge that, and so every deal is different, every deal is unique, and we try and gravitate towards the deals that have a good story behind them. So again, different investors have different hot buttons, and one investor might really like vets deals. Another investor might really like supportive housing or senior deals, or family deals. So, when you are talking to your investor partners, ask those kinds of questions and see if you can help figure out what's the best fit for your particular deal, and find the right investor who really appreciates what you're trying to do.
And I'd say market rate units, just in general, across all the markets that I work in, I'm seeing a lot more deals with market rate units. Being conservative on the rents, making sure that the deal's not carried by those units. Your lender investor can give you guidance on what discount to market you should have. 80-20 deals are very popular. I think up in New York, we're starting to see those creep out. I haven't done one yet, but you're going to see, I think, the marketplace get more diverse in terms of what kind of unit offerings they're going to do.
Okay, thank you. I know we have a couple more minutes, and I just had one more question, and then also, all of the brain trust in here, this is the time to ask the question publicly, and you'll get them on the record. We talked a little bit about tax reform, but I think with uncertainty in the federal budget and where the federal budget's going, is there anything in particular that any of your shops are looking at, specifically as you're putting together, the strength of Section 8 and renewals and stuff like that? Are you rethinking what deals look like because of where the federal budget might be?
Sure. Short answer is no. I mean, obviously, it's a concern of ours, anytime that a program could be cut. But in general, for us, we look at Section 8 and specifically sum of losses pretty consistently, deal over deal. Our metrics there have not changed pre or post-election.
Tony?
Yeah, no, I think that's true. Section 8 is one area that has some investors have concerns about what they would call the overhang risk, or what would happen if that Section 8 were to be reduced or lost. And they do this analysis. So we all do these analysis where we look at that scenario and figure out could the project still continue to operate and pay its bills if there's a loss of Section 8. I would say, Tom, you may have an opinion, but I would say in general, many investors are starting to get more comfortable with taking more Section 8 risk than they were in previous years, and that we're getting less pushback around needing to capitalize large reserves, which I know PHFA hates. Most state agencies hate funding these large reserves that may or may not ever get used. So, we're getting a little bit more, I think, refined in how we look at that risk, particularly if there's a developer who's willing to perhaps take some guarantee risk on that issue as a way to avoid having to put up large reserves. But that appropriation risk is still there, and in the current budget climate, people get worried about what's going to happen to the HUD budget, and is that Section 8 going to continue to be there? But there's more creativity going on around how to address that.
Which is kind of fascinating, given that, I think in 2006, we would have said Section 8 will never go away, and yet there was so much concern about overhang, and we're now in a time when anything seems possible, and yet, so it's good to hear that you're not letting that get to you.
Okay. So I think we have a few more minutes. I'd like to open it up to questions. I know we've had a few questions, and there's got to be a few more out there. Anybody? Okay, Roy, it's you. Yeah, you're making up for yesterday.
Be curious to hear how you're dealing with the short contract period in the Section 811s, which PHFA is encouraging us all to use. It's only a 5-year contract. Of course, we all expect it to be renewed, but it may not. So curious as to your thoughts on that.
We usually, when we do our stress analysis, we usually use a 5-year assumption anyway in that analysis. So as long as it can work under that analysis, the 811 subsidy isn't necessarily better or worse than any other subsidy. But I maybe put Holly on the spot a little bit, that we like to try and get our state agencies to put some sort of assurance in the documents that if the subsidy is lost, that the developer is not necessarily held to those very low AMI targets. And I know Holly and I have had this conversation before, and I'm not sure where the agency stands on that issue right now, but that certainly would be of some help.
I think the answer is where the ones we've put them in, we've actually allowed, in the documents, and I think specifically the use agreement, because that's the biggest issue, that there's some relief there. So I believe the ones that we've done. The other things, any project that we've currently used 811, it's actually been in most cases after the fact, so it's only going to support other projects that already had internal rent subsidies or other underwriting, so that we were allowing for it was only enhancing the project. So if it's not renewed in the out years, that we know that there's the ability for the deal to still pencil.
Sure. I mean, obviously, you'd love the restrictions to come off, and every unit could be maxed at 60% AMI. I'd layer back in other sources of funding. They may have differing criteria from PHFA. And so when you're running the stress scenarios, or your investor is, making sure that you fully understand what every unit reverts to and who controls what. I'd love to see more relief there, because I think, in an unlikely scenario where Section 8 goes away or is limited, I don't think the deals should have these restrictions on them. I think the developer should have the ability to rent to whoever they can.
I think that applies to the Health Choices Capital Funds.
Yeah, and sometimes HPs, you'll see every now and then that their restrictions per unit are a little different too.
Right.
Yep.
Okay, so I'm looking at the time, and we have about a few more minutes. Anybody else questions? Because then I have one for really the group, and so you should have thought about it, this whole panel. If you were to give one kernel of wisdom to these folks in the room about how to either put a deal together or a takeaway, what would it be? Chris, you're first.
Keep on trying and advocate. I just think we just have to keep on hoping and working towards deals, and not giving up on them, and and really just trying to move the needle and somebody out of the government.
Okay, that was taped. I just want you to know everybody
I'm
can,
unapologetic.
everybody can replay it and replay it and replay it. Tom.
Sure, I won't be nearly as exciting. I'll simply say, and we've said this throughout, get the folks involved in your deal together, get them all on the phone, and make sure everybody fully understands what they're signing up for and when it's going to close. I think transparency, it's a cliche, you hear it out of Washington, but is paramount in ensuring that certainty of execution and deals are going to close.
Tony?
I won't be as blatantly political as Chris, but I just, in light of the Frontline show that was on the other night, that, it just highlights the need for all of us to tell the story and keep our elected officials informed about what we're doing, and just put as positive a light on the need and the solutions that we can to keep the funding where it needs to be and to keep the support in Washington for the programs.
I think everybody in this room echoes that, so thank you for those pearls of wisdom. I'm looking at the clock. I think lunch is next. Woo, we just had breakfast, now we're having lunch. I want to thank the panel.
Thank you.
Thank you.
And you can give highlights this panel actually repeats itself, not taped, and probably not the same comments, but we don't have room for you in the next session, so please.
Come back.
But
We'll change the pricing guidance in the next session.
okay, thank you very much.